Hey,
Michael,
Chip.
thanks for joining me here. I want to take a minute and talk to you. You have a long storied history of running money as a fund, right? And so I wanted to kind of pick your brain a little bit as it relates to the grain markets and the livestock markets. I think producers out here hear the term, "Hey, the funds bought today, the funds sold today." They know it affects the markets and the price, but they don't often know or understand what's really at work behind the scenes. So help me understand from your seat. When you talk about the funds and the commitment of traders, how did you operate when you ran your fund? You weren't just sitting there day trading, right? I think that's the biggest misconception that producers sometimes have is there's people out here with $1 billion and they're day trading the markets. You were more of a position trader, right?
Yeah, for sure. I mean, there's a lot to say there because I think the general public doesn't know like what's going on in the professional money management space, especially if they don't have an account with a futures commission merchant or an IB, for example, right? So they just think of hedge fund. Everyone's a hedge fund. Anyone who's got a lot of money has a hedge fund. And that's not generally the case. The Dodd-Frank and other legislative issues have forced a lot of people out of the fund business and set them up to either run money for other people with only, third-party trading authorization, which is not power of attorney, um, in a separately managed account or through a family office arrangement. The word fund is a bit of a misnomer anymore. It was always a misnomer because the word hedge fund used to mean back in the 1950s when it was kind of like the new redheaded stepchild. Hedge fund meant market neutral. In the 80s, 30 years later, it started to mean long leveraged. You have $1 million, you can trade it like it's a lot more money than that and lever your positions for big gains. And that was part, because that's what investors wanted. That was the environment. And two, if I'm getting an incentive fee, which is a share in the profits, and I could trade $1 million like it's 5 million, and I can make 20% on that 5 million, I've actually doubled the corpus in the account. Now, if I work under 2 and 20, under a 2 and 20 structure, I would get 20% of the gain. So that's 200,000 to me as a manager. I'm not saying that that was their motivation to use leverage, but that was part of it. Now, the word hedge fund has kind of come full circle on itself. And many of the managers who have billions of dollars, okay, are really turning into like Steve Cohen, who owns the Mets, had SAC. That's now 0.72, for example. It's a family office. That and the taxation are causing a lot of these folks to move to more tax-friendly environments, maybe not necessarily Puerto Rico, but certainly states that don't have state taxes, such as Nevada, Texas, and Florida, among others. Um, you know, as far as making money is concerned, there are entities that do short-term trading and have a very healthy, high-frequency trading type of an operation where the risk is to find anomalies in pricing. However, they do that and capture those anomalies, not so much like arbitrage, but to use the computers. There's not a lot of human interaction as much as it is programming computers that are co-located at the exchanges so that the latency is very small. That gives them a tactical edge. And then, so that's very, very short term. But they make, tens of thousands of transactions, if not more, for fractions of cents, perhaps, or maybe a little bit more. But then they're back in cash. So the money is constantly churning. My generation and the generation that taught me and the people who still trade that way take a modest amount of risk with or without leverage. You need some leverage. Obviously, there's implied leverage with futures that's built in. But the money is made by holding the risk overnight and over the weekend. The ability to time the market, people, of course, we can time the market, but the studies that I've done have shown that the money is made overnight, right? Because there's risk and reward, and if you take the risk overnight, there's the possibility for the reward. Now, the good news is that these markets trade electronically, so they're open all the time for the most part. There's only a few hours a day where there isn't some form of trading. Of course, in the interbank market, foreign exchange, those markets are open pretty much 24/7, except for a small window over the weekend, which was too much for me on a personal note. I needed to be able to turn off. I couldn't always sleep with one foot on the floor, so to speak, worrying about currency pairs in the interbank currency market. But most of the funds or the professionals, are looking at some type of position sizing, managing the risk, trading their equity curve, right, which we can talk about, but staying with the predominant move, also taking into account what they know after decades and decades and decades of A, observing the market, and two, knowing the seasonality, marrying that with commitment of traders, and then placing their bets in a way, kind of like a diet. They ingest what they can afford to eat without bursting at the seams, right? And they let those positions grow. And with the leverage, they create returns. The key part to all of that, though, is keeping losses small. So it might be, where the individual investor at home is very emotionally invested in needing to be right and needing to make money. They will be overbearing and they'll micromanage the position. Whereas a pro might get in and out 5 times, getting in for a small piece, getting knocked out, getting in again, getting knocked out, and not worrying about what that looks like in terms of the intelligence, right? They're just managing the risk. And then once it takes off in the direction of the trade, up if it's long, down if it's short, they'll add to that position and build it to their optimal size, having unrealized gains kind of baked into the position. Now, they'll be able to calculate what their average cost is for all those acquisitions and then know how to manage the risk according to that average length, if you will, the average buy price, and let the position run that way. And that's
And
kind of
that
how they
doesn't
do it.
always even correspond with a fundamental viewpoint, right? I think from my seat working with producers on the ag side, that's the biggest misnomer out there, that these funds are taking a bet. They know something about crop size. They know something about the cattle herd. They're just sometimes reacting to price and price alone and really don't have an opinion, right, of crop size or anything fundamental or weather related in these markets.
That is absolutely true. There are some traders that are just trading price action. Absolutely, for sure. There are some who do get an extensive amount of fundamental information for current year. There are some who also know historically the term structure, which is, something that's unique. You don't really have that in stocks per se, but you have it in futures. And they can kind of see how the term structure, the strip, is moving. How does it move seasonally? Is it in line with seasonality? And then, again, because they're professionals and they might have a specialty in like grains. And even inside grains, you might just have somebody who trades the soybean complex. And so they know historically the relationship between beans and the products and the crush and inverse crush spreads. They might understand the relationship between bean oil and bean meal and just trade that spread, right? With either futures and or options, right? So there's so many more combinations that the pros can do because they have a stronger sense of the risk than a layperson would. And then they can kind of say, okay, where is the variance? And then what's causing it? Is it inflation, right? Which the inflation isn't higher prices. That's the runny nose of the cold, right? The inflationary event is the printing of the money. Then the reaction to that can be higher prices of goods and services. Then on top of that, we have trade wars, right, and tariffs. So what is that doing to the market? And so they take that all into consideration and have this kind of calculus to, figure out where is there a trade, knowing that they have an advantage that hedgers don't necessarily have. And this is an important distinction. If I'm, using LRP or selling cattle futures to hedge my actual herd of livestock, I have basis risk whether I like it or not because I'm in the cattle business. If I'm raising hogs, the same thing. If I have row crops, same thing. I'm long the physical and I can use futures, sell short. I can buy puts. Selling calls isn't really a hedge, but I suppose you could do it. And then you have, right, so the speculators, though, have the right to not participate because they don't have any basis. They're just underwriting the risk. Or the way we look at futures is they're really insurance contracts, right? And so they allow one entity to buy or sell the risk from another person. We don't know who's on the other side of the trade, but we are underwriting the risk. And for that, from time to time, we can exact a premium. There's always a risk premium attached to the instrument, but that doesn't mean we're going to make money because if we think something's overvalued, like wheat's sold off from over $6, you know, uh, but if we thought it was going to push over to, 620, we could have gone long. We could have been wrong. We could lose. As speculators, we have the right to sit on our hands. We have the right to not participate. So that's a big edge in that we don't have
Yeah,
the
I
same
think that's a
worries.
huge distinction that a hedger can never really be out of the market. A speculator or a fund can choose to sit on their hands and be out of the market, and that's a different risk profile from that standpoint.
100%. So they also look at, like I said, term structure. They know where the grains are. Are the markets, carry charge markets? Are they inverted? And, like right now, corn's a normal market. Beans seem to be a normal market. Wheat is a normal market. Um, it seems like everything is okay in that respect. Um, whereas in earlier this year, that there some of the softs and other markets were inverted, which tend to indicate shortages. So take that into consideration with the political environment and with the concern for like inflation or stagflation and higher costs for like commodities and hard assets. And you have the macro aspect coming into the trade as well. People who are like, well, we don't want to lose purchasing power, right? This is the nature of the kind of people we work with who are, on a 50 to a 100-year plan for asset allocation and diversification. Who are those? Well, single and multifamily offices. We have endowments and foundations, insurance companies, pensions, right? Those trust companies, those types of entities control money in structures like trusts, for example, that will go on and live, if you want to use that word, beyond the life of the grantor. They will survive the grantor. That's the whole purpose, right? To control the money. And they want to make sure that the money that they put aside in those trusts, endowments, and foundations, that they serve a purpose. If it's a university endowment, we can figure that out. If it's a foundation, it could be for any type of social cause that's important to the grantor. And so they don't want to be like, as they say, one and done. 3 strikes, you're out. They want to go on for all intents and purposes in perpetuity. So the diversification, that's where we come in, not as hell-bent for election speculators trying to double your money. It's more like we don't want to lose purchasing power, which is meaning losing wealth because things become inflated. And say the raw materials that some companies use might go up in price if they're not hedged, meaning the publicly traded companies that people own in their portfolios, if those costs for the raw materials or commodities and or currencies aren't hedged, they become a higher expense than for the company, and that could if it could impact net income. So those bigger entities look to us to kind of help them diversify with a small piece. Now, of course, we're talking millions of dollars, but you can put down $5 million and control, 25 million of notional value and overlay any number of those risk units at 25 million a pop to hedge, a $2 billion investment portfolio. And it's transparent and it's free and it zigs when paper assets like stocks and bonds zag. So the goal here isn't again to make, you know, 2 or 3 times your money. That could happen, but it's incidental. That's more dependent on the market and I guess a person's use of leverage. We don't use leverage in that regard. When our returns are modest, I think we're up 23 through November, we're up 23% year. And the most important part is we have a negative 63 correlation to the S&P, 500. So again, when the markets kind of zig, we zag. And that's the point, is to diversify, shifting, what we would call the investment horizon or the investment frontier in and up. So effectively, with just a little bit of an allocation to what they call commodities or managed futures, the client can cut the risk to their portfolio by 20 to, 1/5 to a third in lower risk and enhance the returns by 1 to 200 basis points of the overall operation. That means that it doesn't mean anything maybe for 1 year, but if you start even like for a 5-10 year period window, we've done these in separately managed accounts. There's also structured notes that are principal protected. That's how these entities are thinking. They're thinking over longer periods of time and not losing purchasing power. So it's an integral part to their overall diversification plan.
It's a small slice in the big investment world that may be affecting our ag markets. Talk a little bit too about, I think people have the misunderstanding that, these funds are out here with throwing tremendous amount of risk around and money and, making these massive returns or these massive losses. But oftentimes they control the downside and they're wrong a lot more than they're right. It's money management to them. They know that the winners are going to be multiples of the losers, right? And so they can have a 35% success rate and still make a lot of money for their investors. And it's not taking a lot of risk. And I think that's a misconception that sometimes the ag community has about these funds, is that they're in here just slinging billions of dollars around and, they might make or lose 100 million. I don't think that's necessarily the case. Is it, Michael?
No, you bring up a good point. Again, people tend to, and I'm not saying everybody, but the media, you have to remember what business they're in. They're in the advertising business. And, there's a big competition for people's eyeballs and for their attention. And we're in a world now where it's intentional and attention-based marketing. Gone are the days where you needed a huge following to be able to have a voice. Now you could have 17 followers on Instagram or TikTok and put out a short or a reel and get 1 million views on the thing. If you create the right lightning rod, right? Everything is very clickbaity now. They don't tell you, back in the day, it was the who, what, when, where, why, and how. Now everyone's got to be an editorial writer and give you their opinion. I couldn't care less what anyone thinks about anything, especially as a risk manager. I got to eat my own cooking. I can't do stuff because of some guru or expert. That's not how it works. We have our own algorithm and we stick to it. You can buy everything that you want and try to control the market. The problem is you become a beached whale, and who's left to sell to? If they weren't buying in the first place, why are they going to let you off the hook if you've acquired too much inventory? So the old, if you buy, it doesn't pay to have too much risk. You want to, and one of the things that we look at, and when I do consulting, one of the things we talk about is if something is very thinly traded, you almost have to pass on it because it's going to trade in fits and starts based on headline news. Worse, a lot of those small caps or biotechs, they don't have options. So there's really only one way to get risk on, risk off, and that's buying the shares. if I have $2 billion in client assets and I'm looking to buy a $10 small cap stock that doesn't have options to trade, there's no way I can hedge my risk or take an appropriate bite. I talked about diet before. Most professionals think in terms of risk units, right? I want to risk 1/4% or 1/2 of 1% of my overall account, right? If I have 1/2 of 1% as a risk on a per trade basis in order to be in the trade, well, I have 200 potential mistakes. So my money can go a long way. If I'm trading 25 basis point positions, well, now I have 400 unique positions, right, in my portfolio. So again, it's all about managing the risk. We think in terms of asymmetry, not turning the portfolio into many multiples of itself. So for any particular name, doesn't matter what you want to call it, gold, silver, soybeans, Nvidia, I don't care what it is. In order to put the trade on, we kind of have to see 5 times the upside of the money that we're willing to risk to be in the trade in the first place. We call that asymmetry. If it's 1-to-1, in other words, if I'm going to risk $10 to make $10, now I need a super accurate system of 70 to 80% in order to have that be profitable. That puts a lot of pressure on me. This is a game of expectation, not accuracy. And by expectation, I mean mathematical expectation, which you alluded to in your question. And that is, how can I be profitable? How can my rules, my regimented, and Victor and I are purely systematic, how can our purely systematic rules create money for the clients? We don't charge an incentive fee if our accuracy is only 30-40% of the time. And the way we do that is we look for that asymmetry. Can we get a 4-to-1 payoff with 40% accuracy? We're gonna make money with that. Most people, we're taught from kindergarten or even preschool that accuracy is what we're in school for. The greater the accuracy, the higher the grade. The higher the grade, we get to hang that on the refrigerator at home with the gold star and the smiley face. Mommy and Daddy love us. We're such a smart young man, Master Michael Martin. I can remember hearing that my whole life. The goal here is to think about positive expected value and keeping losses small. To take that a step further, let's say we have 100 trades. We made 100 trades through the calendar year 2025. 60 of those trades were small paper cut losses of, say, 1/4 of 1%. 40 of those trades either broke even or made us 5 to 10%. 100% of those trades are great trades. Most people do what's called resulting, is a term that statisticians use. And that is, I did a process, the result was negative, therefore the process was bad. Or I did something reckless and the outcome was favorable. I bet everything on 00 on the roulette wheel and I won. Reckless behavior, but the outcome was positive, therefore the process is bona fide and legit. And both of those instances is bad risk management. So the goal is, how can a person who's pretty smart learn to live with what in academic circles would be failing grades? Because there's no way a 40%, unless it's some kind of special curve, right? Or class for gifted kids where the questions were just impossible to answer in the time given, right? How can you feel good about yourself when you're wrong 60% of the time? So you have to detach emotionally from losing money is bad. In our world as professionals, losing small bits of money, what I call paper cut losses, are integral to the overall process and being successful in creating the alpha for our clients. My gains will only look like gains to the extent that I can keep the losses small. If I have these wild swings where I'm making 50% on one trade and losing 50% on another, that's an action junkie. That's someone who has no idea what they're doing. Now, yes, there are certain circumstances, and I wrote about this in the book, where I had a small position in live cattle and mad cow hit the tape and the market was locked, offer limit down 5-6 days in a row, couldn't get out. But because my position sizing was, spot on, before the market rebounded, my equity was only down 1.5% to my overall account. That's easy. That's easy to withstand. You always have to position size to keep in mind that if all the moves go against you, what are you going to do, to protect that capital with the mindset of, hey, whatever you don't lose, you don't have to earn back. So professionals aren't going to be sitting there married to the darling of the day, whether it's crypto or AI, and be like, this is the place to be. If you go back and look at the magazine covers from 1995 to 2000, they'd make you feel like an idiot if you didn't own the top 10 names in this new internet space. Vertical Net, Siebel Systems, CMGI, Global Crossing, JDS Uniphase, Internet Capital Group. They're all out of business. Or they're rebranded and they're effectively out of that business. They're doing something else now. They were a shell company before, and they got in and out of the internet business. Now they're doing something else. So we have no idea of what any of these alleged AI companies are going to survive into the next decade and beyond. So again, you have to be on a specific diet for the risk. You can't let your eyes be greater than your stomach, and you have to you have to have prudent risks. Most of the pros know exactly what they're going to lose if the trade goes against them, because it could be bad luck, it could be bad timing. Most of the time, it's not bad analysis. These are super smart people. Many of them have degrees, either MBAs and or PhDs. If they're doing quantitative work, they might have CMT, chartered market technicians. They might be CFAs, chartered financial analysts. Like, these are bright people. And if they don't have those designations themselves, they're hiring those people, and they have a team of them in-house to make sure that there's a full interpretation of what the data is. Ultimately, someone has to put the risk on or the risk off. But it's like the old saying is that carpenter measures twice and cuts once. These people are measuring 85 times. They're not going to be stupid with other people's money. They treat it like a newborn child.
So what I hear you say is that really, when we hear the term the funds, from your seat as a fund manager, you're a risk manager. You're managing risk just in a different way as agricultural producers, whether you're a grain producer, whether you have a feedlot, whether you're a cow-calf operation. That's a different kind of risk management. It all kind of gets thrown into this thing we call the market, and creates opportunity and volatility. But at the heart of it, we're all risk managers, whether we're producers, users, or an investment fund out there trying to make a return for their clients. We're all risk managers, right? That's what I take home from you saying.
Yeah, and not to correct you, but we actually don't have a fund. Everything that we do is a separately managed account. Client has their money in a clearing member of their choice, and we just send the instructions to the clearing member to execute the trades for the client on the client's behalf at the beginning of every month. And then systematically, we hold those positions throughout the month. We rebalance every month if we have to, but there's full transparency, and the custody is really up to the client.
That's a good point. Again, we hear in the ag world, the funds, right? Quote unquote, the funds. That can be several different structures. It's a nice, tidy term that sounds nice and sexy, but there's lots of different entities and structures that kind of fall under that category of fund, to your point.
Yeah, I think the media uses it as a cul-de-sac kind of catch-all term for professional money. But the truth of the matter is that you have to do what the client's comfortable with. And in our experience, because it's a unique asset class that, it behaves differently from stocks and bonds. There are certain things that are similar, like there's a bid ask, that type of a deal. There's a market, there's a structure, there are market makers, there's clearing and custodying of trades and that. But it's really a different business than stocks and bonds. And we never position size. You make and lose your money by position sizing, not by having sniper-like entries or what you might see marketed on TV about the trading platforms or technical analysis. That stuff is kind of important, but at the end of the day, it's not, you know, it's not what makes you profitable. The fear and the greed shows up in the position sizing. So when you're consistent with your position sizing, you're kind of putting on blinders to, your feeling and your sense of opportunity or the FOMO that goes with that, right? Because if you follow your set of rules, which we do, because we're purely systematic, we're never going to find ourselves in a spot where we're being very, very bold when we should be cautious, or just the opposite. We're having too much trepidation when we should have our optimal spot on. This kind of forces us to stay within a healthy boundary of appropriate risk. We never have too little and we never have too much. If the volatilities expand, we can trim. If the volatilities drop, we can increase a little bit. But either way, we have a constant piece of risk on for that particular instrument, whether it's crude oil or gasoline or sugar or a currency.
I think that's a great point too. It brought up a thing that I read once that given proper risk management, position sizing, and cutting losses early and letting profits run, there's been some studies that have shown that you can actually flip a coin and enter long or short randomly. If you have all those other pieces of the puzzle put together, you can actually come out with a profitable trading system, entering and exiting randomly, taking care of all those other pieces of the risk management that you talked about. I think that's what blows people away from my seat being a risk manager on the agricultural side. Is these people think that these fund managers have some sort of inside information, or they know if it's going to rain, or they know exactly what the crop size is. And oftentimes that's, the furthest thing from the truth that's happening out there. They're just placing bets, trying to make a return, managing risk, and letting the profits take care of themselves, not getting out too early, adding to those profitable trades along the way if prices do run one way or the other, and they're going to be there to make money for their investors. So it's a great overview and a great perspective from your chair, Michael.
Yeah. With that, what, we don't necessarily need the risk to the extent that we are helping clients really hedge downside in their paper assets, their stocks and their bonds, you see? But you're actually dealing with people who have basis risk. What is their approach typically to hedging, whether it's, say they have livestock? There's a lot of choices, right? They can sell futures, they can buy puts. I suppose they could sell calls or, credit call spreads. But what goes into their decision-making process? I'm sure there's a lot, but what's
Yeah,
there is very different from the speculator investor side.
it is. Number one, you got to see what profitability is there, and that's what we're struggling with in the grain sector right now. Even as prices have rallied off of harvest lows, it really didn't get to levels that were making a lot of money. So first and foremost, where we at on our profitability scale, because we have all these inputs that we have to pay in order to raise a crop, or whether we're producing, beef cattle or calves with a cow calf operation, we have a certain amount of inputs that we have to pay in order to produce the commodity that we're producing. So profitability is one. Also, I'd say that farmers, ranchers, they generally are not an all in, all out. It's hard for a producer to come out here and with one, click of a mouse, cover 100% of the hedge 100% of their production. So they're more like of a scale in type of a mentality,
Mhm.
especially if you're in profitable levels. And now you have the wrinkle of, on the cattle side, this LRP insurance that has become really a very useful tool. On the row crop side, we've had crop insurance products out there for a long, long time, and that's part of it. So there's a lot of moving parts out there, Michael. It makes it harder to develop, a risk management plan because there's so many options. You mentioned just a few of them. Is it a put strategy? Is it a short future? Is it an actual physical sale? I'm calling an elevator and selling some of my physical production. Is it tied to a crop insurance or insurance policy? Really makes it difficult. And from our standpoint, we function more as a consultant, helping people kind of ask some of those questions and figure out what their personality type, is most appropriate for a particular, type of a plan. Because not everybody can just go out there and sell 100% of their crop with short futures. They're not, mentally able to make that hurdle, and there's margin call situations that are possible in that environment if you're using your own account to hedge. So it's different for every person out there. There's no one size fits all, and that's part of the beauty of it. But that's part of really what the hard part is in producing one of those plans.
I got to figure too, like the cattle rancher and the farmer of row crops, they have, fixed and variable costs that go into, you know, um, their operation, right? They have fertilizer, seed, they got water, they got labor, they got notes on their tractors and hardware and machinery. They might have retirement benefits that they have to pay out. They might even be renting the land on the farm. Like, so there's a lot going on inside the price of the actual commodity. And they might be in a spot where they're only able to sell, you know, their production once or twice, a year, like at some kind of harvest or
Right.
at some kind of hundredweight. You know what I'm saying? So they're in a precarious spot to really have to protect a lot of things because a lot's riding on the price of the commodity. Whereas for us, the price
For sure.
is price action is key, but it's we have the right to not participate in anything. And so, we can find ourselves um sitting on the sidelines and not necessarily worrying about anything because we don't have the overhead that they do. Doesn't mean we're going to be overly cautious, but when you're purely systematic, there needs to be a signal. There has to be a catalyst for adding or removing risk. It's not just like, oh, what do we think the government's going to do or the FOMC is going to do with interest rates, or what do we think the president's going to do or say in social media about tariffs between the US and a certain country that could impact commodity prices for a particular market. We have no way of knowing any of that. So that's complete guesswork. Maybe there are people who have some kind of think tank, mentality where they can guess, but at the end of the day, it's not something we do.
Yeah, and again, it makes it very unique to your point, and that's why I think in this whole discussion of giving producers a little peek behind the scenes of what the fund or investment side of the futures market entails is so much different than what the production side entails. And it is a little bit of all or nothing mentality because sometimes there's 8, 9, 10 months that go by and prices are below the cost of production. And sometimes there's some insurance products that have the ultimate backstop if prices, kind of the worst case scenario type, you know, cover my worst loss type scenario. And
Hmm.
then there might be a rally in the markets that producers, have waited for months for, and they have to act very, very quickly because they can't be out of the market. They're producing whatever crop, or product, livestock that they're producing. Unless they retire or sell the business, they're going to produce it this year and next year and 10 years down the road. And they can't ever be out of the market, so to speak. Whereas that fund side can choose to be out of the market for extended periods of time. So there's a lot of overlap there. Great discussion. And, pretty thought provoking, I think.
Yeah. I mean, the thing is like, if you don't manage the risk, it manages you, and that's the worst place to be. You know what I'm saying? That's why
Yeah, for sure.
we have
For sure.
a strict diet of what we have in the various commodities. There's 60 of them in the portfolio, and we don't really waver from that. Um, it's a set. Think of it like a recipe from a chef. Everything plays off of one another. So the relationship between the positions is also kind of set. We don't adjust, to take into account if we're bullish on gold or bearish on the yen or something like that. We don't, trade that larger. All the position sizes are architected to be a part of a bigger picture. So it's more or less a long short index, commodity
Don't
index.
get in your own way, right? Stay out of your own way.
Yeah, I mean, we have our methodology and we stick to it. And so instead of buying like the S&P, you can work through us and we can buy, you know, a sizable amount. Again, it's institutional. It's not typically for, you know, unless it's ultra high net worth folks that are, have nine figures or more of net worth. Because again, the diet is 25 million. That's the risk unit of notional exposure to these 60 different commodities markets. And the risk, how they play off of one another, is advantageous to the client to create the alpha and also provide a hedge, which is really what this is, to their, stocks and bonds. So it's a different role for sure than what some investment advisors play, but it's essential because again, the only free, and I think this is Milton Friedman, you know, diversification is really the only free lunch that you get, basically. So the question is, how do you want to control the risk the best way you can for what your client's goals are, not just now, but what they want for future generations and or for their charitable, concerns through trusts, or foundations. So it's a different mindset in risk management. So
Yeah, and I think it's good for us. Sometimes we put, myself included, put my blinders on that it's just a farmer. It's just a feedlot operator. There's a lot of moving pieces and players in these markets, and that's good, right? We don't want three people involved in the market. We want as many, to your point, diversified players in our market to give us the fairest chance, um, and the best opportunities. So,
well, that's just it. I mean, too, and the markets are very, very fair in that, it's a very pluralistic place. If you are a small speculator, there's a seat for you at the table. If you're a large hedger, there's a seat for you at the table. And just like for stocks, the market is a voting mechanism. So depending on how you come to your decision-making process, there's a way for you to participate. The key, of course, is if you have bad luck, bad timing, or in the case that you have bad analysis or you discounted something that you shouldn't have, um, you have to have a specific type of risk that you can get out of. If you take on too much risk, you know, it makes it difficult to unwind a position. So you have to be very careful about what is your temperament for risk. We have it down to a science. Um, we advocate that everyone else should too.
that's great, great advice. Probably a good place to end it.
Yep. Well, good chatting with you today. Let's do it again. Coming into January, we'll reevaluate stuff and come back and
That
have
sounds
another
great.
chat.
That sounds great. It's always a pleasure, and I think it's been enlightening at least from my seat, to understand there's a lot more players out there in our markets than maybe what we realize here at first glance.
Understood. Thanks for your time today.
Thanks, Michael.